Hidden behind the global financial system is a powerful institution quietly influencing the entire economy: central banks. They do not manufacture goods or sell services, yet their decisions shape borrowing costs, inflation, employment, and long-term economic growth. In many ways, central banks function as the control center of modern financial systems, influencing both markets and everyday economic activity. A hidden architecture designed to balance growth and stability. A central bank is the primary monetary authority of a country. Its core responsibility is to manage the national currency, maintain financial stability, and control inflation over time. Unlike commercial banks, central banks do not provide loans to individuals or businesses directly. Instead, they operate at the system level, guiding financial conditions through monetary policy. One of the most powerful tools central banks use is interest rates. Interest rates determine how expensive borrowing becomes across the economy. When rates fall, credit becomes cheaper. Businesses invest more, consumers spend more, and economic activity accelerates. Lower borrowing costs often encourage expansion across industries. Small adjustments at the source create massive shifts in the real economy. But when inflation rises too quickly, central banks typically raise interest rates. Higher borrowing costs slow spending and investment, reducing demand across the economy. This cooling effect helps stabilize prices. However, raising rates too aggressively can slow growth and increase unemployment, making policy decisions complex and delicate. Central banks also influence the economy by managing the supply of money and credit. Through financial operations, they inject liquidity into the banking system or withdraw it. These actions determine how easily banks can lend money to businesses and households. Liquidity conditions often shape overall economic momentum. Managing the floodgates of liquidity is a delicate, constant operation. Another key policy tool involves government bonds. When central banks purchase bonds, they inject money into financial markets and increase liquidity. When they sell bonds, they remove money from circulation. These operations influence borrowing costs and financial stability across the economy. During financial crises, central banks act as lenders of last resort. They provide emergency liquidity to stabilize markets, support banks, and prevent systemic collapse. Their interventions often restore confidence and reduce panic during periods of uncertainty. When systems fail, the central bank stands as the final line of defense. Most central banks operate with a specific inflation target. Maintaining stable prices protects purchasing power and supports long-term economic growth. If inflation rises too quickly, policy tightens. If inflation falls too low, policy loosens to stimulate activity. Through these tools, central banks influence borrowing, spending, investment, and financial markets. Their decisions ripple through every layer of the economy, from multinational corporations to individual households. Even small adjustments can produce significant economic effects over time. The global economy is a single, interconnected web of cause and effect. Central banks also coordinate globally during major economic events. In an interconnected financial system, decisions made in one country often influence markets worldwide. Monetary policy has increasingly become a global force. Financial markets closely monitor central bank signals. Even small changes in expectations can move stocks, bonds, and currencies dramatically. Markets respond not only to decisions themselves, but also to tone, messaging, and forward guidance. The market doesn't just trade on data, it trades on expectation and trust. Over time, central bank policies shape economic cycles. They influence credit expansion, asset prices, and financial stability across decades. Their decisions affect not only the present economy, but its long-term structure. Although often unseen, central banks shape the structure of modern economies. Understanding their role is essential to understanding modern finance itself. Central banks are the control centers of modern economies. Their influence touches nearly every aspect of economic life. This is Capital Blueprint,